Good day, everyone. Welcome and thank you for joining today's edition of Teneo Insights. I'm Kevin Kajiwara in New York City. Once again, conflict in the Middle East is roiling global energy markets. The war with Iran has led to the effective closure of the Strait of Hormuz, in turn leading to the largest global oil disruption in history. While the duration and outcome of the conflict remain to be seen, Iran has demonstrated it has a stranglehold on the world economy. This disruption comes in the midst of a protracted energy transition, a phenomenon impacted by engineering, geopolitics, geology, climate, the list goes on. So how does this latest event fit into the bigger energy complex picture, both long-term and with this year's CERAWeek starting next Monday, the immediate discussion as well? Here today to help us think through the dynamic and the variables, I'm joined by two colleagues. Dan Gabaldon is the Vice Chair of Management Consulting at Teneo and the Head of Energy. Dan has spent his consulting career focused on the energy transition, strategy, and policy issues, and began his career as an energy economist. Emily Stromquist, a regular on this program, is a Managing Director in Teneo's Political Risk Advisory practice, focusing on energy in the Middle East. Earlier in her career, she was with the International Energy Agency, the IEA in Paris. I'd like to thank both of them for joining me today. Emily, maybe I can start with you because obviously the ongoing closure of the Strait of Hormuz, the news just this morning that Israel may have attacked, or Iran is claiming that Israel has attacked their South Pars gas field, and Iran has then said energy complexes throughout the region are now legitimate targets. We have seen initial U.S. attacks against military targets on Harg Island, the key export facility for Iran. But the threat of an attack on the energy infrastructure does loom out there. I think everybody's aware of the general parameters here, right? That 20% of the world's oil and natural gas passes through the Strait of Hormuz on a daily basis. We've got the largest kind of disruption in history. But I think maybe, for the benefit of our audience, kind of give us your view on what this all kind of means and portends to those in the energy markets, both those who are trading energy, but also those in the production of it. And we'll get to how the consumer ought to be thinking about this in a moment. But let's start with the big picture.
Look, you've captured very well the latest picture. What's critical to remember about energy markets is that in this conflict and in any conflict really in the Middle East, energy is always the most significant point of leverage. It's been largely avoided by the U.S. in particular in the conflict to date. I think this crossing this threshold into starting to target energy kind of exacerbates the existing issue that we've already seen where higher energy prices are passing through the market because of disruptions through Hormuz. I guess what's interesting at this point is obviously Brent has hovered over the $100 per barrel mark. I think for markets getting over the 125 one is kind of the psychological barrier where we can start to see larger shocks across the economy. Certainly much more probable if you're starting to target broader energy infrastructure while Hormuz remains disrupted. I also think it's very important to remember that this is a material economic drag right now across the global economy. Even if Hormuz were to open tomorrow, and shipping were to resume in relatively short order, it would still be weeks to months to get some of the production back online, to do repairs where necessary, and to sort of sufficiently reassure shipping as well that this is a safe passage and get reinsurance back in place. So I think, in terms of short term, we're looking still at sustained significant disruptions. High prices have obviously had social impacts, work and school disruption, for example, in Southeast Asia due to power outages. It's had significant economic impacts, disrupting business as usual with power, fuel shortages in cooking fuels, impacts across tourism, airlines, agriculture, you name it. It's had very extensive, widespread impacts that continue to feed through supply chains as we speak. Higher energy prices obviously feed into transport, into manufacturing, into food costs. So this threatens a reversal of globally the disinflation trends that we have been seeing. And I think, this is a prime time to be talking about this because we see several big central bank decisions that are happening this week on rates across the globe. Those will be a very important litmus test for how the market is kind of perceiving what's going on right now. There's speculation that in some markets we could even see a reversal and increases in rates by later this year. So I think this is a very pivotal time where we're seeing this escalation across regional energy markets, and that will continue to pass through with delay for some time still.
Now, you say that oil has been sort of hovering in this $105 range and hasn't yet accelerated to that psychological threshold. Do you think, in your view, is the market sort of accurately looking at it? It does seem to me that last week when the IEA, your old employer, announced the 400 million barrel strategic reserve release globally, oil actually traded up on that. So it's still this focus on that, that was a release valve, but it actually wasn't addressing the underlying issue.
That's right. A lot of these decisions, including the waiver on Russian crude exports, are ways to temporarily ease the market. I think especially on refined products, being able to distribute them where there are disruptions, significant disruptions, and that's particularly in some of the Asian markets in Southeast Asia. It certainly helps ease that immediate concern. These are not long-term solutions, so the volumes are nowhere near significant enough to sort of account for the 14 million barrels or so that are transiting through Hormuz regularly under normal circumstances.
And the global 100 million barrel a day demand. And I believe just another data point in these sort of piecemeal measures you're talking about, I believe the president just this morning did formally announce the waiver of the Jones Act as well. But you were talking about the economic impact. Let me just ask you a follow-up on that as well, because oftentimes when you've got a crisis like this emerging in the Middle East, and everybody kind of jumps to looking at historical precedent on that front, but the American economy and the American energy complex are, not to mention the global one, but let's focus on the U.S. for just a moment, is actually quite different than in the past, right? Not only are much more less energy intensive per unit of economic output, but also much more energy independent. But talk about the sort of the dynamic, and particularly as it pertains to the U.S. economy on that front.
Yeah, so clearly, as opposed to other oil price shocks, particularly between the 70s and the 90s, we're in a very different circumstance where the U.S. has become an independent energy producer now. The non-OPEC countries have seen significant growth from anywhere from Guyana to Norway. We're seeing increases in production that can help offset and also help reroute when there are significant market disruptions. It's not significant enough when you look at global balances among refiners, the types of feedstocks that refineries need around the globe. It's not sufficient enough, these changes in the market, to fully offset some of those disruptions, but it is certainly very different dynamics than what we were looking at decades ago with oil price shocks, and that's helped to at least blunt the blow a bit from this current disruption.
I'd like to bring Dan into this conversation because Dan, obviously, when hostilities broke out and even leading up into it, the media immediately jumps to oil, of course. But it also strikes me that the Persian Gulf and then the Strait of Hormuz choke point in and of itself is equally important in gas markets, and particularly for Qatar to be able to get its product to market. But Emily's been talking about the dynamic on the crude markets. Let's talk about gas here a bit.
It's a great point, Kevin. The gas market has been really severely impacted, particularly in Europe and the UK especially, as well as in Northeast Asia, where we've seen price increases of 20, 50, 60% across some of these different markets. And that's because of two basic factors. Number one, natural gas is more expensive to store. So therefore, it's short-term, even very short-term disruptions have a quite significant impact really quickly, even more than in the case of oil. And secondly, there's a greater dependence upon Qatar as the lowest cost supplier of LNG globally, but also the largest, so about 20% of the total volume, which is even greater than the case of crude. And in the case of crude, there's other ways to get out of the Gulf. In the case of LNG, it's much more limited. And I'd also raise, the impact on power prices. Natural gas sets the power price in many economies, including the east coast of the US, and Texas and California, and certainly in Asia and in northwestern Europe. So this increase in natural gas price flows almost one to one, a little bit under, across these different markets. And of course, electricity price is something that folks in the industrialized world, especially in the US and in Europe, are less frequently, or that it's been less historically, it's been uncommon for a correlation between sort of global events and what happens to local electricity prices. But now that the natural gas market is more interconnected globally, all of a sudden voters and consumers are going to see, hey, this affects not only my gasoline price, but also my electricity price.
So if you're a consumer or in the electorate in Europe, this has got to be sort of a deja vu all over again. After the situation with Russia and Ukraine broke out in 2022, Russia, Europe spent the next several years cutting that energy, that gas umbilical cord to Russia. Now it's getting caught out again, and perhaps is overly reliant even on the United States as far as gas imports are concerned. Talk about what's Europe's going to do here?
Well, there's a couple of kind of dramatic political choices they could make. One would be basically allowing natural gas from Russia back into Western and Central Europe. And of course, some of the political actors on the eastern side of the EU would be very happy with that decision. Uh, it's quite worrisome for folks who are thinking about the Ukraine conflict in this context as well. So that's one, quite possible outcome. Another, which we're already seeing signs of for broader reasons, is loosening some of the constraints around the energy transition, around decarbonization. So there've already been requests to drop basically carbon taxes in the near term associated with the ETS in Europe. So that would at the margin buy a little bit of time and a little bit of price relief. But I guess as we'll get into later in the conversation, as this crisis continues, that's just as Emily was discussing in the case of crude, it's probably not sufficient.
Can I ask both of you a technical question, if I may, both on the gas and on the oil front? Dan, you just made a point earlier that gas is more expensive to store than oil is. But one of the stories that's been kind of percolating out there as the choke point remains essentially closed at the Strait of Hormuz is that storage in the region and on ships that are already in the Persian Gulf is starting to fill up. So what happens when storage facilities get maximized? What is the field response, or what does field management then what happens on that front? And does that have long-term kind of technical or ultimate recovery ramifications?
Emily?
On the oil market side, we've already seen Gulf countries moving to shut in some of their production because of full storage tanks. It depends on the field. It depends on how long this progresses. That can take weeks to months, depending on whether there was any damage, depending on reasons and process for how quickly that can get restarted. But at least a matter of weeks to get some of that back online. With gas storage in Europe, and I'm sure Dan can speak a bit more to this as well. But this usually there's an entire refilling season, right? And that takes place from about now, end of heating season, through to kind of the next winter. So there's a longer run time to deal with refilling gas storage. So it's a bit of a different process than with oil in terms of sort of how fungible and the kind of timeline to build up reserves.
Yeah, and that's exactly right. And one of the reasons the impact on gas prices has not been as dramatic as it could have been is we're not in the middle of the winter right now, and we're at the beginning of sort of filling up gas storage around the world in the northern hemisphere. So that makes it a little bit easier. There's one other point I'd raise here, maybe in this broader context, which is the impacts across different geographies are very distinct, but across different markets as well. So even on oil, we think of oil as very fungible, but production from the Middle East can't just be easily replaced by production from other parts of the world because refineries, as Emily knows very well, are really customized to take a particular grade of crude. And we saw this with the Venezuela impact as well, where it was good for some refiners, not so good for some other refiners. So even as there's some storage for particular forms of crude, and it will mitigate some of the near-term impacts. There's a lot of displacements, a lot of secondary displacements, which can affect gasoline prices and diesel prices around the world.
I'd like to close out this segment by asking both of you a couple of sort of geopolitical questions that arise out of this. So clearly, the transiting of the Strait of Hormuz is a function of supply, demand, the ability to ensure the ships that are going through there, and the willingness of the crews so to traverse. What if it seems to me that Iran has proven that they have, and they know they have a stranglehold over over the Strait of Hormuz, that very narrow choke point, and it doesn't take a lot for them to asymmetrically, effectively close it down. Although, interestingly, it appears that they're letting their own ships through, of course, and so it sounds like Iranian crude making it to market is not that much lower than what it was prior to the conflict. But in any event, I guess my question here for you, Emily, on this is, do you see it that way? And if you do, because what it looks like right now is that however long this conflict lasts, it is looking increasingly like some remnants of the previous regime are going to continue to be running the show in Iran, which means that they could do this again. And so the question then, I guess, becomes that we've gone from the constant hypothetical assumption that Iran may or may not ultimately do this to they have now done it. So does a permanent or permanent for as far as we can see, premium need to go into the price of both oil and gas coming out of that region, and therefore into the global price of oil at least? That's going to be now a permanent fixture of the price.
Certainly, I think some of that premium is going to remain on for some time. I don't think we're getting a clean solution to this conflict. Even if there's a ceasefire agreement, we're staying in a very gray area with this conflict where proxies haven't been fully dealt with. We don't have sort of confirmation of the extent to which weapons capabilities have been degraded, which is obviously one of the key indicators for the Trump administration to announce victory. So I think with some of this kind of remaining in the gray area, that's going to leave some of that kind of price premium on pressure, or price premium on prices for quite some time still. And I don't see that easing off significantly without sort of broader redressing of capabilities. I think in the interim, what will take some of the pressure off is that you are likely to see, as the Trump administration puts pressure on European countries, on other allies to join a naval coalition, you will slowly start to see other countries joining that because of the broad economic consequences that we're seeing and the need to get the strait reopened. So that's sort of the immediate trigger that relieves some of that pressure. Some of that stays on, some of the price pressure stays on, and you need to see sort of a much more kind of significant and robust addressing of the security situation before the rest of that comes off.
So I'd like to turn now to kind of the bigger picture, the longer term picture. And Dan, this all comes in the midst of this long, protracted, bumpy energy transition that's going on around the world. And that energy transition has caused a lot of commentators and media and market participants and the like to focus on metals and minerals and elements and so on that have been that are essential to the 21st century kind of energy transition, and kind of relatively less concern about the hydrocarbons and all that's obviously come back full force as per the conversation we've just been having. But in an environment where the Trump administration has been very focused on drill, baby, drill, and has eschewed some of the alternative energy and renewable energy sources. But clearly, the electorate is getting itchy over, affordability. And, we've already seen how sensitive gas prices are, diesel prices, et cetera, aircraft jet fuel to the oil price, and how quickly it adjusts. But, you know, you focus on the energy transition and the increasing demand for electrification around the world, but also obviously with the build out of the AI data centers, which are so energy hungry, et cetera. Talk about how this all feeds into the context of this bigger picture right now. I know this is a huge topic, but maybe you can start to break it down for us.
A couple of points to start things, and maybe picking up from the last point about, hey, if Iran and this region remains kind of unstable, what are the ramifications of that for the broader change in the energy system? The term energy transition is very definitely out of favor here in the US, although much less so in other parts of the country, or other parts of the world, I should say. So one of the long-term ramifications, I think that we'll see of uncertainty around the surety of natural gas showing up, we'll see, I think mostly in Asia, is folks aren't going to be able to count on it. So there'll be some price ramifications, but there's going to be reluctance to remain reliant in the case of Northeast Asia, or become more reliant in Southeast Asia on natural gas as opposed to coal, for example, and going forward nuclear. We were at the Doha LNG conference a few weeks ago, back when one went to Doha easily. And there's a great deal of anxiety among gas producers that there's going to be excess LNG capacity, and a lot of sort of explanation of why that wasn't so bad, that it would allow for the downstream applications of natural gas in a lot of economies in the developing world, especially in South Asia, to develop demand. With this is a big advertisement that, hey, maybe we shouldn't be counting on that quite so much. So that's one aspect, and I think it'll have some perhaps interesting ramifications for how the US responds to all this in terms of LNG development. Another ramification in terms of energy transition, I think we've seen in the case of China in particular, and in the case of US, having a robust set of energy alternatives is really a powerful strategic lever for being able to work through this kind of a crisis. In the case of China, that's been sort of all of the above in terms of energy resources, rapid development of coal, but also nuclear, renewable, et cetera, as well as lots of different ways of bringing natural gas into the country. So I think we're seeing this idea of an all of the above strategy, and relying quite heavily on domestic resources like coal, frankly, but also things like renewable energy and nuclear is quite advantageous. And I guess the last point I'll make in this broader context is, I think we're seeing the really serious ramifications of the supply, the ability to maintain adequate supply to get through a crisis. In the case of nuclear, fuel cycles, especially with next generation nuclear, can be 7, 10, even 20 years. So if one's a national policymaker and thinking about what resources do I want to have, something like nuclear, where I can have 10 years of assurance, even if there's a disruption, is quite reassuring. Renewable, along with batteries, also provides that kind of reassurance. We're seeing that with natural gas, especially where you have to rely on waterborne natural gas, where there's no longer an obvious sort of global military hegemon who can protect sea routes. It looks a little bit riskier than it did. So I don't think this doesn't stop electrification globally. That's driven by deeper economic factors. But I think it will give people pause about natural gas perhaps being, as seemed apparent 6 months ago, the most obvious near-term solution for it.
I know you started your response here by saying that energy transition is a term out of favor in the U.S. right now. And I also know that this sort of there's a kind of caricature, if you will, of the Trump administration's attitude toward renewable energy. It's not quite as simplistic as some would make it out to be, but nonetheless, it seems to me that one of the things that this most recent crisis has also brought forward again is that energy independence, energy sovereignty, frankly, is as important a driver as the climate change imperatives and so on and so forth. So is that in your view impacting the administration's view on the optionality that's potentially available to them, or are they going to remain more narrowly focused?
Yeah, and in energy circles, we often talk about a trilemma of security, you know, environmental quality, and affordability. And over the last several years, you know, one was very much in sort of the camp of environmental quality as being really the biggest concern. In recent months, affordability has been a bigger issue. Now we're seeing sort of security becoming the big issue again. I I certainly don't, I wouldn't pretend to know how the administration is going to respond to this. One of the things that's consistent from an affordability and a security perspective, though, is really emphasizing development of nuclear power in the longer term. Right now, nuclear has proven to be rather expensive in lots of instances, but this administration's been, very positive about promoting nuclear technology in this country, which gets to this kind of energy security solution and can get past some of the, exposure to, sort of climate, sort of weather-related risk associated with intermittent renewable energy. So I think this will reinforce their interest in that. What it does to the emphasis on LNG, it will be interesting to see. On the one hand, clearly, if we had more LNG capacity right now, that would have helped out this situation quite a lot. On the other hand, it's a double-edged sword in terms of linking, more LNG capacity, increases the linkage between domestic natural gas prices and global natural gas prices. And I wonder how people are going to feel about that going forward, having local electricity prices affected by these global events.
And it's worth noting as well that there is no real silver bullet here, right? I mean, Dan, in the sense that all of these alternative energy sources that you're talking about, it just sort of opens up new problems in terms of the supply chain, right? I mean, you need uranium feedstock for the nuclear program, and you need critical minerals, including heavy rare earths and rare earth magnets in many cases to run a lot of these operations.
For sure, but there's a difference though, I think, and we're seeing that. I think one of the lessons of this crisis has been the impact of the duration of the crisis. We're all very sensitive to that right now in terms of near-term prices. So having access to rare earth metals is something that you need when you're building building the equipment once, and then it's going to live for 20 years. And you need access to the uranium for nuclear once every 7 or 20 years. With natural gas, nothing, we love natural gas, but with oil and natural gas, and we haven't really talked about coal yet, but you can't store it very much, as we've talked about. So it needs to be constantly replenished. So this temporal dimension and the security dimension are sort of being revealed as really closely interlinked. That said, for sure, there continues to be big security dimensions to all of this.
Can I just pick up then on the coal point? I want to go back to Emily in a moment, but on the coal point, obviously, we have seen a sort of a topping out of coal use, perhaps, or a high point, say in China, as an example. Even though they continue to open coal plants, but that seems to be mostly for in case any of the renewables are unusable or there's surge in demand or whatever, they can fire these things up at any moment. But I note that in the last week or so, the United States has announced a deal to build its first coal plant in 20 years or what have you, with an agreement with the South Koreans to build the boilers on that. Talk about where coal is now, and particularly in the U.S. context.
I think the coal-fired generation has been in decline in the United States for several years, because of environmental regulations, but above all, because of falling natural gas prices. And the utility industry thought it knew where things were headed. There was a question about the pace, and there was quite a lot of contention around, how much longer those coal plants could live. This administration has been, very strongly pro-coal. The utility industry has reacted in a varied way, shall we say, in different parts of the country, including a lot of the biggest coal users, the current coal users in the Midwest. I think it would be surprising based on what we've seen over the last few years for there to be a significant increase in coal capacity in this country moving forward. That said, if gas prices for some reason remain higher, we could see existing coal plants stay in service longer than expected because the dark spreads, because the profitability of those units will be higher. And also, this can be affected by what happens with how data center demand ends up playing out. So we're not going to be able to retire things quite as quickly if this demand surge actually is realized that we're expecting. But I don't know if this is a reversal, Kevin, to the sort of longer term trend with coal.
And Emily, obviously, one of the most memorable campaign lines of this administration was drill, baby, drill. But yet, I think over the course of this administration so far, the rig count has actually declined in the United States. Talk about the oil business in the U.S., particularly with these, other variables, not just with regards to the crisis, but the essential assumption of the energy business in Venezuela following the removal of Nicolas Maduro. Talk about the oil sector.
So I think, it's interesting in the US in particular, because you have oil and gas companies that will do quite well in this environment because of the higher oil prices. But there's going to be that tension between, higher profitability for oil and gas, but higher consumer, tax because of the higher price at the pump. So I think especially as we run up to midterms, that's going to be a very critical question to be thinking about. More broadly, I think there's still, to Dan's point and the comment about the kind of all of the above energy outlook, there's still this question of, particularly given what's happened around Hormuz and targeting of energy infrastructure broadly, there's still this question about how to allocate capital to build resilience and ensure that no one fuel in particular kind of outweighs the market. And here we are seeing massive increases in investment across the energy space, but split between fossil fuels, renewables, grid investments. So capital is flowing toward resilience and returns rather than toward kind of pure efficiency, to Dan's point. And I think, when you layer on the fact that we're seeing, very strong policy intervention that's impacting industrial strategy as well across different markets, this is really creating kind of this fragmentation. So I think something to look for is both how companies respond not just to the higher prices, but to these kind of fragmentation in where does climate policy factor in, how are we pursuing industrial strategy, and what that implies for how kind of markets self-select and create blocks amongst themselves, right? Even in the US, the response to this crisis has been to look south. You can see more of these kind of north-south interconnections emerge, for example, where it used to be an east-west trading dynamic. So I think these are very important, dimensions to watch that are still very much in the making, but could kind of create some new dynamics that we haven't sort of been particularly accustomed to in energy markets in recent years.
So finally today, I'd like to turn to CERAWeek. Dan, next week, all you and your buddies are going to go to your annual big brouhaha down in Houston. For those unfamiliar with CERA, it is sort of the Davos of energy conferences, if you will. Industry will be represented. The administration will likely be represented in force. So Dan, I guess I'd like to ask you what you're kind of expecting the tone and tenor to be down there, both in terms of what you hear at the sort of the plenaries, but what's the the sidebar and deal making going to kind of look like as well, and how has that changed since before what you were expecting prior to February 28th?
Yeah, I mean, it's been as boring as it might sound, it's actually a pretty interesting microcosm of the world in a way. 3 years ago, many of the oil and gas majors were rather apologetic about the business they were in. This started out as Dan Jurgens' kind of oil and gas fest for international and national oil companies getting together. And everybody was sort of bending over backwards trying to say how they were really hydrogen producers, they were, lithium producers. And yeah, we might produce some oil and gas in the background, but, we're all about the energy transition. Then last year, there was a kind of a real spring in the step of the oil and gas industry, domestically as well as internationally. There's sort of a recognition because of the data center boom that we need as much energy as we can possibly get, that natural gas was back in a very big way domestically, and it was actually one of the critical constraints around data center build out. And there was ebullience around LNG as well. I think now I like the term that Emily used in terms of fragmentation. I think there will be a lot of deal making around energy, electricity sector topics around nuclear in particular. There's a lot of excitement. There's a lot of Trump administration support for those deals with Japan and Korea and so forth. That looks also quite interesting in a Middle Eastern context, and the Emirates and Saudi were also very active in that area. Back to the point about domestic energy supply being so critical in this context. So I think we'll see a lot of deal making about that. And then I think there's going to be quite a lot of talk, which you'd be very comfortable with, I think, about sort of the geopolitical dimension of all this, where we see China in particular, which has a stranglehold, or, I don't know if that's the right term, but quite a lot of control over critical rare earth metals on the one hand, and has a domestic supply demand situation, where they can sort of be on the sidelines of some of these conflicts. I think the geopolitics of the energy industry is going to be more at the forefront than it has been in recent years, not surprisingly.
And Emily, I'll give you the last word here on this, but I know you were anticipating going down there as well, but events in the Middle East maybe conspire to keep you in Washington. But what are you anticipating coming out of that or looking for?
Yeah, I think it's an interesting dynamic, obviously, at the moment, given everything that's happened. But I think, we have seen this gradual shift in attendees' commentary, especially last year. We saw kind of a noticeable shift in dynamic following, Trump administration 2.0. So what I would suspect is that we're going to see kind of these two distinct corporate responses at CERA. Given this is taking place in, I'm biased, but my favorite U.S. city, Houston, and in the U.S., you're going to see public alignment with the administration where beneficial, but that's going to be paired with quieter hedging around risk, uncertainty, long-term strategy. They'll praise, on the one hand, permitting reform, approvals of LNG expansions. They'll speak of energy pragmatism, but I think they'll remain very cautious on policy volatility and also on investment risk, which obviously calls for durable and consistent policy frameworks. You'll see lobbying behind the scenes, especially to preserve subsidies, especially some of these IRA-related subsidies. So I think this is a lot of what I would anticipate seeing, is just how do we hedge risk in this environment that has become so uncertain, both geopolitically and from a policy perspective.
Well, all of these issues are going to be in the news for the foreseeable future due to the ongoing conflict in Iran. As Emily pointed out at the beginning of the conversation, the Federal Reserve, as well as other central banks, are rendering their rate decisions this week. The Fed today, later this afternoon, I would listen carefully to Chairman Powell's comments on the complexity of inflationary pressure with slowing growth and how that challenges the Fed's dual mandate. And as well as Dan has just been pointing out, and Emily as well, the news headlines will be coming out of Houston and CERAWeek next week as well. As events warrant, we will readdress these issues on this program. But until then, I'd like to thank everybody for joining us today, and I'd like to thank Dan Gabaldon and Emily Stromquist for joining me. Until next time, I'm Kevin Kajiwara. Houston may be Emily's favorite town, but New York is mine, and that's why I'm here. Have a great day.